So you want to buy a house, but you don't know where to begin. In this series, we'll cover home buying basics to equip you with essential foundational knowledge, as well as take a deep dive into home buying's many nuances. And by the end, I hope you feel confident and empowered to make the best decision for you. First things first, you must get pre-approved with a mortgage lender. And remember, not all lenders are created equal. I recommend steering clear of all online lenders, credit unions, and major national banks. And if a bank name just popped into your head, then more than likely not that one. So how do you choose a lender? Well, the odds are you know several real estate agents, and chances are they each have a selection of reputable and vetted lenders that they've worked with, know and trust, blah, blah, blah. So ask your agent friends which lenders they recommend. But if I'm your only real estate agent friend, then ask me. The lenders I work with and trust also happen to be licensed mortgage lenders in many states across the US. Why do you have to get pre-approved right off the bat? Because you need to know where you stand financially. You need to know how much you can afford based on your income, assets, credit score. You also need to know if there's anything potentially affecting your mortgage qualification. And an excellent lender will help you create a plan, which may include how much to save for a down payment, ways to improve your credit score, and maybe even which debts to prioritize paying off first. Additionally, they can help you decide which loan types or programs could work best for you and your situation. So I know interest rates are a very hot topic right now, and while interest rates are undoubtedly crucial to consider, remember that they're national. So the interest rates offered in Washington are the same interest rates offered in Kentucky, for example. Additionally, interest rates fluctuate daily, and you won't be able to lock in your interest rate until you're under contract, which means you've submitted an offer and the seller has accepted it. With that said, it's also important to understand that lenders have limited flexibility with the interest rates they can offer. So if you happen to encounter a lender that's advertising lower than average interest rates, there may be additional fees you have to pay to lock in that rate, which ultimately increases the cash you owe at closing. So now that you're pre-approved and you know what you qualify for, ask your lender to show you loan estimates at various price points. In loan estimates, you'll see line by line how much everything will cost and exactly how much cash you'll need to close. But most importantly, in the loan estimate, you'll see what your estimated monthly mortgage payment will be. Typically, your monthly mortgage payment will include your property taxes and homeowners insurance wrapped all into one payment. So once you've gone through a loan estimate and dissected all that information, you decide how much you can and want to afford monthly. And then from there, you and your lender can determine which price point makes the most sense for you to search in. So here is a very Cliff Notes simplified version of what happens after you're pre-approved. So you and your agent, you find a property that you want to write an offer on. So that agent will get your offer written up and submit it to the listing agent, along with the pre-approval letter that you receive from your lender. The listing agent will review your offer and decide to accept it based on the terms outlined in your offer. However, many of the terms are usually contingent upon the lender's pre-approval of the buyer and the buyer's loan type, the lender's appraisal, and the closing date promised by the lender. Unfortunately, if a lender inaccurately pre-approves a buyer or fails to complete the loan package before the agreed upon close date, the buyer would be in breach of contract, and the buyer would be the one to bear all the contractual consequences. And that's because the lender is actually not part of the binding contract between the buyer and the seller. Most buyers don't realize it, but the lender plays an incredibly important role throughout the buying process. This first step, the finances, the loan, the assistance, and the education on how you're able to actually buy and own a property is the foundation of this whole process, and a determining factor for how easy or stressful the process could be for you. And it's all based on the lender you choose, their reputation in the industry, the quality of their customer service, and their ability to explain complex concepts clearly to you. Because of the risks associated with choosing lenders, I recommend my clients work with any of my preferred lenders. That way we can all feel assured that they're in safe, qualified hands, and we're all able to get to our close date, the finish line, unscathed, worry-free, and happy. So let's get back to talking about loan estimates. Again, once you're pre-approved, your lender should provide you with loan estimates to help you understand the costs involved with purchasing a property and to give you a more accurate estimate of your potential monthly mortgage payment. These loan estimates will truly help you wrap your head around the financial side of purchasing a property, which is quite frankly the most important part of the entire home buying process. I mean, obviously, if you don't have the finances to purchase a property, then you won't be able to buy one. However, what is equally important is that if you don't understand the finances involved in purchasing a property, the harder it will be for you to make a decision that you feel good about. So you'll want to see loan estimates comparing different down payment amounts, different price points, or a combination of both of those. And all this is meant to help you determine exactly what your budget is, so you can figure out the cash needed for your down payment plus settlement costs, and also to help you understand your monthly mortgage payment commitment for the next 30 or so years. Actually, the 30 or so years comment is technically inaccurate because the average life of a loan is somewhere between 6 and 10 years. And this means that a homeowner refinanced their loan or sold their house before the end of the 30-year term. And a loan refinance could be a cash out refinance or a refinance to lock in a lower interest rate, or a refinance out of necessity, like during a divorce, for example. Okay, now let's get into the loan estimate. As of February 2024, the median sold price for all of King County, Washington was $940,000. So I have a loan estimate for a property priced at $950,000. Okay, so here is an example of one loan estimate. And as you can see, we have the home price here at $950,000, and we have 3 different scenarios to compare from. And we're comparing, in this example, 3 different down payment amounts. So in scenario number 1, we have 10% down, which would be $95,000. Scenario 2, we have 15% down, so that's $142,500. And then in scenario 3, at $950,000, we have 20% down, which is $190,000. And then this line just shows how much the bank would actually be loaning you. All right, so if we scroll down, so all these different scenarios are conventional loans, all for 30 years. The interest rate when this home estimate was put together was at 6.75%, which again, interest rates fluctuate daily, and you won't be able to lock your interest rate in until your offer has been accepted by a seller. So until then, they're always just estimates from what's happening that day. So the interest rate across the board is the same, 6.75. And then we go down here, and this one is showing mortgage insurance, so PMI. So this column is, again, 10% down, so 10% would give you a PMI of $158. 15%, your PMI is 141, and at 20%, you don't have PMI or mortgage insurance because you're putting 20 or more percent down. And then we have an estimate for homeowners insurance right here, and you would get homeowners insurance usually from like anyone you would get car insurance from. Your Allstate, Pemco, Safeco, Geico, those kinds of places are who you get homeowners insurance from as well, or can get homeowners insurance from as well. And then in this column, this is showing property taxes broken down by each month, because your property taxes and homeowners insurance are usually combined all in one to create your mortgage payment. So in these three scenarios, we have your three different mortgage payment amounts here. So $950,000, 10% down, your monthly mortgage payment would be about $6,340. At 15% down, mortgage payment would be at $6,016, and at 20% down, your mortgage payment is at $5,567. And then this is showing what your closing costs or settlement costs will be at each down payment amount, which they really don't change very much from one to the other. And then your total cash at closing is your down payment amount plus your closing costs. Okay, so then this page here will show you what your closing costs break down into. So you have your appraisal fee. The lender's going to have an appraiser come out and appraise the property, credit report, underwriting, your escrow, title insurance, recording fees, all of that go into your closing costs, which is broken down right here, $6,354 to $6,269. And they're different because, again, these are the different down payment amounts. And then your prepaids, which get lumped into your closing costs, those are essentially you prepaying interest days. That's a little bit complex and not something you necessarily need to worry about now. But then you're also paying in advance for your homeowners insurance and your property taxes, and that usually equals somewhere around here, the $7,000 to $6,000. So these two combined equal your total closing costs here. Around $13,000. So that again, closing costs $13,000 plus your down payment amount here equals your total cash at closing here. Okay, so that's just at one purchase price at different down payment amounts, but we can also get into different purchase prices at the same down payment amount. So let's say you're thinking that this property could sell in multiple offers. So it's really competitive. You might have to escalate in purchase price in order to get this property. So I have it here escalating in $25,000 increments. So we have $975, $1 million, and then $1,025,000, all at 20% down. This is what the down payment amount would be. Again, interest rates all at 6.75. No mortgage insurance for any of them because you're doing 20% down at all three price points. Again, we're factoring in homeowners insurance and taxes. And then we have your total monthly payment here, $5,722 up to $5,981. So each $25,000 increment up. Let's see if we can break that down a little bit so you can see the difference. So from $975 to $1 million, your mortgage payment would change by $129 a month. So you go up $25,000, your monthly mortgage payment changes $130. And then from $1 million to $1,025,000, your mortgage payment will change, again, $130. But we also have the $150 at 20% down. So this mortgage payment is $5,567. So let's compare $975 to that. So from $950 to $975,000, your mortgage payment will change $155 a month. So it's helpful to see these escalation increments so you can really understand, like, okay, if we do have to compete and we do have to escalate in price, what does it actually mean and break down to me on a monthly basis? So you're able to see that right there. For some people, that's not a big change in monthly payment, and for some people, that's too large of a change in monthly payment. And then your cash at closing, again, these are the same down payment, same 20%, but at different price points, $975, $1 million, and $1,025,000. So this is how your total cash at closing would change. That's maybe $10,000 difference between $975 and $1,025,000. And closing costs are pretty much about the same, maybe just slightly different. And then again, they break down here, really not much variation between the three different price points, escalating in $25,000 increments. So this is helpful to know and help wrap your brain around competitive situations where you might have to increase your purchase price. Understanding exactly what increasing your purchase price means makes it easier to come into a competitive situation. What some people have been doing recently is doing an interest rate buy down, where you can buy your interest rate down temporarily. I mean, there's a bunch of different options, but this is just one. So again, we have $950,000 as the purchase price. We're doing 20% down for all three scenarios. The only thing that's changing here is our interest rate. So this is a 2-1 buy down, which means you're buying your interest rate down for the first and second year, but they're tiered. So the first year you close, your mortgage payment would be 4.75%. And then the second year, your interest rate increases to 5.75%. And then the third year, your interest rate increases again, but it increases to the rate in at the time you bought your property. So right now they're 6.75%, but in 3 years they could have gone up or down or whatever. If they go down, surely you can refinance and then lock in that low rate for the next foreseeable future. But sometimes this is a good option for people so that they can save some cash monthly for the time being. Okay, so then how does that change your monthly payment? So again, no PMI, we're factoring in estimated homeowners insurance and taxes, making your monthly mortgage payment for the first year at 4.75% would be $4,602. That second year, it would increase to 5.75% interest, so then that would be $5,073. And then that third and final year, when the rate resets to the rate that was there when you bought the property, you'd be at $5,567. So the one caveat with this though is that it costs money to lock in an interest rate. So as you can see here, the total fees and costs for closing would be $34,460. So that is significant from the previous ones, which were around $13,000. And then your total cash at closing, again, that's down payment plus closing costs. So why are the closing costs so high? And that's because we have this added buy down fee in here of $21,000. This is actually helpful if the seller was able to credit you like $20,000 at closing, because then that $20,000 could go straight to buying this down for you. So then your closing costs would then remain the same as it was in previous examples, but you still get the benefit of having this interest rate buy down for the first couple years. So then again, we break it down to closing costs at $28,000 plus the prepaids, makes your total cash at closing or the closing cost be $34,000. As a buyer, your goal might be to try and reduce the purchase price when you're negotiating with the seller. And to a seller, whether the price gets cut down or whether the seller pays for a portion of the buyer's closing costs, it doesn't matter, because at the end of the day, the seller is still getting that much money less at closing. This property is priced at $975,000, but you're hoping to get it for $950,000. The monthly payment difference for the buyer between $975,000 and $950,000 is $155 per month. So you're paying $155 per month less if you reduce the purchase price by $25,000. And to the seller, they're just losing $25,000. So seller's like, whatever you want, however you want it, whatever. But another way to look at it is the seller could pay your closing costs instead. So instead of reducing the purchase price by $25,000, let's just say you keep the purchase price at $975,000, but you ask the seller to pay your $13,000 in closing costs. It would take you 7 years of saving $155 a month to equal $13,000. Keeping cash on hand is more valuable, so you might as well have the seller pay your closing costs instead of reducing the purchase price down, because the break-even point between the two in this scenario is 7 years. While the majority of home buying expenses are combined into one cashier's check at closing, there are a few expenses you'll have to pay out of pocket before closing. And these expenses can occur either before mutual acceptance, before a seller accepts your offer, or they can occur just after mutual acceptance. Before you've even written an offer on a property, you can choose to do a pre-offer inspection. This type of inspection usually happens when you'll be competing against other buyers. And the reason you would do an inspection before you even write and submit your offer is to make your offer stronger and more compelling to a seller. Pre-offer inspections usually cost between $400 to $600 each. And while you're doing your pre-offer inspection, you could also have a sewer scope done, which is basically a colonoscopy of the house to ensure that the sewer line from the house all the way to its connection point to the city's main sewer line is in good condition. And a sewer scope usually costs between $200 to $300. After a seller accepts your offer, your first expense will be earnest money, which is usually 3 to 5% of the purchase price. It's typically paid in the form of a personal check and needs to be deposited with escrow within 2 days of mutual acceptance, and ultimately becomes part of your down payment at closing. After you've deposited your earnest money check with escrow, if you did not do a pre-offer inspection and a sewer scope beforehand, and your offer is contingent on an inspection, then you get to have a standard inspection and sewer scope completed. And a standard inspection can cost between $500 to $700, and then just like before, a sewer scope costs between $200 to $300. After you've gotten through your inspections, next on the list of things you have to pay for is an appraisal, and I'll explain more about an appraisal in a bit, but they can cost between $750 to $1,100, depending on your loan type and the time we have remaining until closing. Because if we're trying to close quickly, for whatever reason, we might have to rush order the appraisal for an extra fee. If you're buying a condo, you'll have all of those same expenses minus the sewer scope, but you'll also have to pay for a condo questionnaire, which is needed by the lender to obtain information from the HOA. Those can cost between $200 to $600, but generally average around $350. And also, if you're buying a condo, you have the option to hire an attorney to review the documents within a resale certificate so that they can narrow down all the information in the report into the information that matters to you most. So having that professional consulting fee is about $200 to $300. And actually, this step can happen before mutual acceptance as well, depending on how everything is going. What to expect during a home inspection? A home inspection helps buyers make informed decisions about the property and understand its current condition. As the buyer, it's highly recommended for you to attend the inspection. This is your chance to gain valuable insights into the property, ask questions, and allow you to make an informed decision about your purchase. During a home inspection, a qualified inspector examines every aspect of the property from its roof to its foundation and everything in between, including key areas like plumbing, electrical systems, heating and cooling systems, appliances, and its structural integrity by going into the attic and crawl space. The inspector's goal is to identify issues that require repair, future maintenance, and estimate the remaining useful life of major systems. The length of an inspection depends on property square footage, age, and the property's general condition. However, in my experience, they usually take 2 or more hours. Inspections can take place before submitting your offer with the seller's permission, known as a pre-offer inspection, or once you have a mutually accepted purchase and sale agreement, referred to as a standard inspection. Additionally, sellers may opt to have a home inspection completed before they list their house for sale, and then provide buyers with their seller procured inspection report. So let's dive into these 3 different types of inspections. Pre-offer inspection allows buyers to assess the property's condition before submitting an offer, typically in competitive multiple offer situations. And these inspections are conducted with the same level of thoroughness as a standard inspection, but they do not include a written report, so you'll want to take diligent notes during a pre-offer inspection to remember the inspector's key findings. A standard inspection happens after the buyer's offer has been accepted, and after the inspection, you'll receive a detailed report outlining any issues discovered. So then, armed with this information, you can potentially negotiate with the seller to address repairs, have the seller pay a portion of your closing costs, and or reduce the purchase price as needed. And then we have the seller procured inspection, which are initiated and paid for by the seller before listing their property for sale. A licensed home inspector evaluates the property's condition and provides a detailed report to the seller, who will then disclose this inspection report with all its findings to potential buyers. This transparency can boost buyers' confidence in the property's condition and facilitate smoother negotiations. However, buyers may still opt to conduct their own inspection for peace of mind as well. Okay, so what's the difference between a home inspection and an appraisal? Often, buyers and sellers confuse the inspection with the appraisal and use the 2 terms interchangeably. However, they are very different and they serve very different purposes. A home inspection focuses on the condition of the property and identify any existing issues that may need repair. The buyer is given a detailed report outlining all of the property's major issues so that the buyer can then negotiate repairs or adjustments to the purchase price with the seller. And an appraisal aims to determine the fair market value of the property to ensure that the lender is not financing more than the property is worth. The appraiser creates an appraisal report, which is used by the lender to determine the max amount they are willing to lend to the buyer for the purchase of the property. What are contingencies and why are they important? Think of a contingency like a safety net or a get out of jail free card that can allow the buyer to terminate the agreement or terminate the contract and keep their earnest money. Now remember, earnest money is 3 to 5% of the purchase price. That's a lot of money to potentially risk forfeiting to the seller if the buyer must break the contract outside of the agreed upon contingencies. So a contingency provides a way for the buyer to terminate the agreement if certain specified conditions do not meet the buyer's standards or if certain terms cannot be met. This is why it's very important for you to know what contingencies you have available to you within your contract. These are the 3 most common contingencies used in most real estate contracts. You'll have your inspection contingency, which allows the buyer time to have the property inspected, and if the buyer discovers any small or major issues with the property that they don't want to have to take on themselves, they could just walk away. But if the buyer wants to try and negotiate with the seller some type of remedy for the repairs needed, whether that's closing cost credit or a reduction in purchase price, or if the buyer just wants the seller to have all the repairs completed before closing, they can try and do all that. But if the buyer and seller can't come to an agreement, then the buyer can walk away. And also during the inspection contingency, the buyer could just simply change their mind about buying the house entirely, walk away, and keep their earnest money. Next, we have the financing contingency, which protects the buyer if anything with their pre-approval and financing fall through. Example of this could be losing your job before closing, or having some kind of significant decrease in credit score before closing, sudden increase in credit card debt, things like that. Basically, any event that could significantly alter your financial circumstances where a mortgage lender deems you ineligible for financing. In an unfortunate scenario like this, you may be able to walk away and keep your earnest money, which is why you should not make any job changes or make any major purchases after you reach mutual acceptance, like buying a car or buying all new appliances or furniture for your new house. You must wait until after closing so that none of those things mess with your pre-approval. And then we have the appraisal contingency, a safeguard for the buyer and lender in the event that the property you're purchasing does not appraise for your agreed upon purchase price. If the appraised value comes in lower than the purchase price, this contingency gives you the option to withdraw from the contract or try and renegotiate the purchase price with the seller. Essentially, this contingency ensures that you're not obligated to pay more for the property than it's worth, according to the appraiser's valuation. However, this contingency can also make things very tricky and harder for a buyer if they're in a competitive offer situation and need or want to escalate in purchase price in order to beat out other buyers. Now, I'm sure you're asking yourself, if contingencies are so important, why would I ever want to waive a contingency? When housing inventory is low, but buyer demand is high, there could be several buyers competing to purchase the same property. And this is what will lead us to our next topic, how to write a competitive offer. I won't go into too much detail here because every offer and situation are different. But to understand the basic gist of a competitive offer, we have to look at it from the seller's perspective. During a transaction, the seller really only has control over the offer they choose. But once the seller accepts an offer, the buyer is in the driver's seat. And that's because the contingencies within the buyer's offer allows the buyer the opportunity to walk away or renegotiate contract terms like purchase price, having the seller pay a portion of the buyer's settlement costs, or the buyer can ask for an extension of close date, etc. And often all the seller can do is agree to what the buyer wants, try to negotiate with the buyer, or disagree and risk the buyer walking away. All of this could be bad for the seller depending on their situation, timeline, and potential financial needs. And since the seller only has control before mutual acceptance, before they even accept an offer, the seller and listing agent's goal is to select or negotiate for the most secure offer they can, especially if they receive 2 or more offers, and even more so if they receive several offers. If a seller is getting a number of offers, all they have to do is look through their offers and pick the best one for their situation. Or they can choose to try and negotiate with the top 2 or 3 offers to see which one of those becomes their best offer. Sometimes that means it's the offer with the highest price. Sometimes it means it's the offer with little to no contingencies. And sometimes it's a combination of all of it. Highest priced offer, no contingency, a safeguard for a potential low appraisal, especially if the buyer is escalating significantly above list price, and a quick close date. Of course, an offer like this is inherently and extremely risky for a buyer and buyers. If you're getting a loan and a lender is involved, your agent and lender better be like this, because they need to know how to communicate with each other. There needs to be trust from both ends, and both need to be extremely contract educated and savvy in competitive markets in order to minimize the risk for you. And the biggest risk for a buyer is losing their earnest money, which again is typically 3 to 5% of the purchase price. So this is exactly why you should not choose just any agent or any lender off the street to guide you through one of probably the biggest purchases you'll ever make in your life, where the risk is losing thousands of dollars. And for the majority of my career as a real estate agent in the greater Seattle area, the market has been a competitive seller's market. My goal as a real estate agent has always been to guide my clients through the home buying process, making sure they stay out of the hot, sticky legal waters, and to ensure that they make it out on the other side, owning the home they want for a price that they know they are comfortable paying. So that concludes this video on home buying basics, or home buying 101. And if you'd like to see more videos on topics like this, feel free to like and subscribe. And you can also reach out to me via email, and I can maybe help answer any of your questions that way as well. All right, bye for now.